In the landscape of economic discussions, one prevailing theme has become impossible to ignore: the possibility of an impending recession. The narrative has been one of optimism, with media outlets suggesting a strong economy and a potential soft landing. However, a deeper look into the money supply paints a different picture. This critical factor, often overlooked, is now signaling that an economic slowdown may be unavoidable. Hello, and welcome back to Economic Hero, your go-to channel for insightful economic analysis and financial strategies. Today, we're diving into the complexities behind the current economic climate and why experts like Professor Steve Hanke from Johns Hopkins University are sounding the alarm about a potential recession. To understand why there's growing concern, we need to explore the role of the money supply in the economy. Imagine the money supply as the fuel that powers the economic engine. When there's plenty of it, the engine runs smoothly, but when it's restricted, the engine starts to sputter. Since March 2022, the money supply has contracted, a rare event that has only occurred 4 times in U.S. history since the Federal Reserve was established in 1913. Each of those contractions led to a recession, making the current trend deeply concerning. So, what's causing this contraction in the money supply? To answer this, we need to rewind to the early days of the COVID-19 pandemic. The Federal Reserve took drastic measures to avoid a severe economic downturn by significantly increasing the money supply. This approach was intended to boost economic activity and stave off a deep recession. By February 2021, the money supply had surged by an unprecedented 27% year over year, far exceeding what many economists, including Professor Hanke, considered sustainable. Hanke suggests that there's an optimal growth rate for the money supply, a golden growth rate that promotes healthy economic activity while keeping inflation in check. However, the Fed's aggressive expansion in 2021 pushed the money supply well beyond this ideal level, setting the stage for the inflationary pressures we're now experiencing. By mid-2022, inflation had reached alarming levels, peaking at 99.1%. Recognizing the consequences of their actions, the Fed reversed course, implementing measures to contract the money supply and slow down economic activity in an effort to control inflation. However, economic effects don't manifest overnight. Just as it takes time to steer a large ship, changes in the money supply take time to impact the economy, typically 12 to 18 months. This delay is a key point in Hanke's argument. While the Fed's contraction might seem like a necessary step, its full effects on inflation and recession risks may not be apparent for some time. The economic fallout from the rapid money supply growth in 2020 and 2021 is still unfolding, potentially leading to a recession despite recent efforts to tighten the money supply. To further understand this dynamic, let's look back at the financial crisis of 2008. During that period, the Federal Reserve implemented 3 rounds of quantitative easing, significantly increasing the money supply. Despite fears of rampant inflation, this didn't happen. The reason? Banks were making a negative contribution to the money supply, largely due to restrictive regulations like Dodd-Frank and increased capital requirements under Basel III. If not for the Fed's interventions, we might have faced a much deeper recession. Fast forward to 2023, and we see history potentially repeating itself. High interest rates and the collapse of several banks have caused a ripple effect. Banks, already cautious due to stringent regulations, have become even more reluctant to lend. This tightening of lending conditions further restricts the flow of money in the economy, creating a perfect storm for a recession. With less money circulating, businesses struggle to access credit, consumers cut back on spending, and economic activity slows down. The historical context is crucial here. The most severe contraction of the money supply in U.S. history occurred during the Great Depression of the 1930s, with a staggering 39% decrease. This contraction is widely seen as a major factor in the severity and length of the Great Depression. More recently, the recession of 1937-1938 was also linked to a tightening of the money supply by the Fed. These episodes underscore the critical connection between the money supply and economic health. Today, the contraction we're seeing is about 4%, less severe than past contractions but still significant. Economist Steve Hanke warns that we could see as much as a 4% economic contraction in the next 12 months. This prediction comes despite the U.S. stock market reaching new highs, a disconnect that can be unsettling for investors. For investors, this environment calls for a cautious approach. Diversification becomes key to navigating this uncertainty. Holding cash allows for flexibility and the ability to take advantage of buying opportunities that may arise during a market downturn. Investing in gold can provide a hedge against inflation, as it historically maintains its value even when stock prices fall. Additionally, U.S. Treasuries, particularly short-term ones, offer stability and income during economic volatility, being one of the safest investments backed by the U.S. government. In summary, the shrinking money supply is a significant red flag for the economy. While it might not signal an immediate recession, it does suggest that economic challenges are on the horizon. As we navigate these turbulent times, understanding the role of the money supply and its impact on economic activity is crucial for making informed financial decisions. Thank you for tuning in to Economic Hero. If you found this analysis insightful, please give us a thumbs up and subscribe to our channel for more content on economic trends and financial strategies. Stay informed, stay prepared, and we'll see you in the next video.